It's time for Wise Money with Korhorn Financial Group with financial advisors Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of Wise Money with Korhorn Financial Group, where every week we are helping you take your next wise step in your financial life. My name is Mike Bernard. I am your host and one of the certified financial planners on the show. Across from me, certified financial planner Kevin Korhorn, and between us, certified financial planner and CPA special guest Ryan Fair.
Ah, yes. A thorn between two roses. So that's right. Today, we are talking about taxes. And if you think, what would I want to be talking about today? It's got to be taxes, right?
That's right.
So we're going to help you get ready for this upcoming tax season. We've got some great questions that you should be asking. You're going to have great answers if you start with the right questions. So whether you've already started gathering your documents to get your taxes done, or it's not even on your radar, we're going to get you ready to make this your best tax season ever.
I know you got goosebumps. I know you do. And just to help you with that, we are going to be talking about taxes this week, but also next week as well. We're taking a quick break in our series about the biggest financial choices that you have to make. We're going to talk about tax laws and your tax process today. We are going to talk about those big tax choices. So next week, if you have a question, and I know you will because it's tax season and Washington, D.C. has screwed everything up. So you're going to have questions. Reach out to us. You can do so in a few different ways. wisemoneyradio.com. You can submit a question right there on the right, as well as catch up on previous episodes. Call or text 574-222-2000. Lastly, Facebook, Twitter, and the YouTube channel is hot. Just search at Wise Money Radio. Welcome back, Ryan Fair. Glad to have you on the program. And, we're about to the point where I'm not going to have you introduce yourself anymore.
I know.
But just really quick, who are you?
I trimmed it down. I'm Ryan. Been here at the team since 2001. Switched over to the tax team 2005. So this is my 12th tax season?
Yeah, wow.
Man. So
A crusty veteran.
I know, an old man.
The graybeard of the KFG fleet.
So yeah, basically, I started in the tax stuff back in 2005. Really enjoyed taxes and helping people figure out their tax prep and tax planning needs. And now, before we know it, we're doing over 2,000 tax returns. We're going to do 2,500 total tax returns.
Come on.
But over 2,000 households will help in the Michiana area, which is awesome.
And I'm glad you used the word help. I didn't know you were going there. But if you've never done tax planning, this is the year that you need tax planning. You need to sit down with a professional. My guess is sales of TurboTax are going to be way down. The do-it-yourself idea this year, especially, you got to get in front of someone and answer some questions. I have 3 questions. Kevin's already teased me about it. Every time you get your taxes done, you've got to answer 3 questions. And I thought we'd give you those 3 questions today so that you can answer them. And then we'd frame them with Ryan Fair here with us to just all help us get the thinking right. So the very first question you need to answer when you get your taxes done, you need to make sure, are they accurate? Am I getting all the deductions, getting all the credits? Do I have all my information in there? Is this an accurate tax return? There again, I would hope that you're using a CPA. But Ryan, talk about the importance of that process, the importance that, or the process that you use with the team here.
Yeah, Mike, as you know, one of our core values here at the company, part of our mission statement is education. And so that is always a big part of the tax process for us. When we're doing the tax returns, when we're done, and even through the process, we like to educate the clients, help them understand what in the world is going on with their taxes. So many clients have lots of questions that they just want it. They're curious, and we can help those clients out. Those people that are really curious, I always encourage them, schedule a meeting with us. Come in, meet. You can ask all the questions you want during our meeting. And a lot of those meetings, we can work on the tax returns and even get them done or most of the way done in the meeting. And, we can chat while we're doing them and smooth sailing. So those are the best case scenarios for me where we can actually just talk through stuff. They can ask the questions while we're face to face. Other clients, that just doesn't work for them, or they don't, they're not as curious. They just want to drop stuff off and be done with it. Well, we have the education part covered for those clients also. Whenever we're done with a tax return, we always offer a tax delivery meeting. So even if they just drop their tax paperwork off, we do the returns, call them when it's finished. They're offered a tax delivery meeting. And so they can come in and meet with someone on our team to actually review the tax return line by line, go through and explain what the numbers are, where they came from, and how they're impacted by it. So
You need to make sure your return is accurate, and you need to make sure you understand why you got the result you did. And that's a little bit of our experience, our client experience here. We prefer to get in front of the folks that we serve to address their questions right there, but then also just make sure we've got all the documents and everything looks good. Is that accurate? But even if you don't have time to sit down face to face and you just drop your information off, we want to sit down with you on the back end to review it, to make sure we've got the most accurate return and that you understand why the result came out the way that it did.
Yeah, and I would encourage you. I want to talk to you today if you haven't filed your taxes for a couple of years and you're feeling you're listening to this and saying, I can't do it. I just can't face it. Ryan, what would you say to that person right now?
just do it. We can help. I mean, you wouldn't believe how common it is for people to just kind of emotionally check out due to something in their life where they just put the taxes on the back burner. They're scared. They just don't know what the result's going to be, and something else is kind of taking over their brain where they forget about taxes, and it's not the end of the world. We can do that. You have to do them sooner or later, and so why not do them now? I mean, just.
And we've also seen where people will come in with maybe 5 years worth of taxes. And in each of those years, they would get a refund.
Yep.
But you can only go back 3 years
Right.
and get your refund. So a lot of times you create in your mind this scenario where it's much worse than it actually is.
Yep.
So come in and work with someone who just loves people and has a bedside manner that will make you comfortable and isn't going to make you feel bad.
That's right.
Right.
That's right. So step one, question one is my return accurate? Did I get all the deductions? And do I understand why the result came out the way that it did? And for those of you who always do your taxes, do them yourself each year, I would hope that you're able to address at least this question. A lot of people don't. TurboTax will you just answer questions and then it just tells you what your refund is or how much you owe. You really don't understand where those numbers came from and how accurate they are. So once you've got an accurate return and you understand where the information came from and what the result was and why, you then have to ask yourself this question. Is there anything I should be doing about that? Is there anything, even though I've got my return done and maybe I haven't signed it and sent it in yet, I haven't filed it, is there something I can still do? Usually that answer is yes. And if you're not working with a certified financial planner and a CPA who does planning, you're going to skip this question, but it's critically important. Let's talk about some of those things that are after the fact. The year's already over. You're about to submit your tax return, but you're still able to do some things to improve last year's taxes.
Yeah, so there's a number of things that we look at with clients when the returns are done, see what we can do to help them further, even for the prior year that we're doing the taxes. Always look at IRAs, Roth IRAs, health savings accounts. So those are the biggies that, they're easy and you can fund them until April 15th, or the tax filing deadline, and you can do it for the prior year, which, a lot of times it's an obvious, based on whatever tax bracket you're in, you can write off the IRA, traditional IRA contributions, reduces your tax. There's also lots of other planning stuff that you would think just little IRA contributions are straightforward. With the new Affordable Care Act penalties that are involved, or the premium repayment stuff that you have to do if you're on the healthcare exchange, we've seen huge impacts by making an IRA contribution or an HSA contribution. That it's huge.
Yeah, there's you need to know that list, and we're going to talk about this a little bit more. But before you send in your taxes, before you sign that e-file, before you submit your taxes, you need to know what are the creative ideas that I can do, that I can still do to improve my tax situation. And then you go through and say, well, I shouldn't do this one, and this one really doesn't work in my situation. But you know what? I'll do some of this one. You've got to make that list first and then see which of them make sense. The third question we're going to get to in just a moment, in my opinion, is the most important and the most missed. So we've got a lot more coming up here on Wise Money with Korhorn Financial Group.
Okay, so are we still in the after the fact?
Yeah,
things that I can
I'm
change?
assuming that we
Yeah.
still want to talk about how important
I
that is.
think, I think the where is it that we kind of highlight and underline? I want to look back at the tax strategies that I used for last year, but I want to look forward
That's the third question.
and make sure. Okay.
So, 17, yeah. So this is stuff that we do, unconsciously here at KFG. But
Right.
to make it conscious to everyone else is make sure my return's accurate. What should I do to improve it? And then how do I look forward at what I should do? That's just, folks on YouTube, this is what we do all day, every day. This is what we've done for 20 years for folks. And to distill it, it's really down to those three questions. So let's just touch on the importance of looking
So
backwards.
should you lead with those three questions?
I'm teasing them out, man. Teasing them out. Getting people on the edge of their seat.
I know, but if I just ran into a place where I could save big money, I might not hear them all.
That's why I didn't want you to spend 4 minutes explaining certified financial planning in the last show. Oh. Come on. We got to go.
Radio show drama.
Mike was right
That's
again,
right.
though.
All right. So is there a couple, we mentioned IRAs. Do we want to talk about limits to IRAs? Do we need to talk about, you talked about the Affordable Care Act. That's where I was going to go. You need to be aware if all of a sudden some of your credits are starting to be phased out, you need to look at that.
I think you need to know if you're on the bubble. I don't think we'd talk about limits or dollar amounts, but am I on the bubble? If I made a deductible contribution to my IRA or to my HSA, would I bring my income down low enough to get the retirement savers credit?
Yeah. Those sorts of things I still had on my list. So
And there's nothing I can do after the fact for educational type stuff. It's done.
no, but you do have a choice of what credits you take, credit or deduction, right? And it's kind of,
For this year, not next year.
oh really? Yeah.
Yeah, and hey, so it won't matter next year about my exemptions, right? There are no exemptions.
Isn't that crazy?
So
new
I was going to
world.
get my folks to move in with me. Forget about it.
So, well, you can get the
Yeah, there's an extra
Tax credit.
$500 credit.
So once we
Are
get
you
to,
serious?
Yeah. Once we get to the
Hey,
things
Dad.
that you could do for this
worth
year, I'm assuming you've got a list of a whole bunch of things that are going to be changing for 18. Mm-hmm. Okay.
I think you said get 3 of them ready. So
Yep.
I've got
That's
So hopefully you have
huge
8.
list. I could take those 3 and make 3 segments.
true.
What can you still do right now to improve last year's tax situation? That's what we're talking about here today. This is Wise Money with Korhorn Financial Group. My name is Mike Bernard. Across from me, Kevin Korhorn. Between us, Ryan Fair, coming to you from the KFG studios. Special thanks to the attorneys at Ledoux, Curran, and Keene, as well as First State Bank for sponsoring the content of today's program. If you have any questions, we're talking taxes. We're going to be doing so next week as well. If you have any questions, reach out to us. Call or text us, 574-222-2000. That comes right to me. We'll hit that question on an upcoming program. You can also find us online, wisemoneyradio.com, as well as social media at Wise Money Radio, Facebook, Twitter, and YouTube. So anytime you get your taxes done, you've got to ask yourself 3 questions. And not just ask, you need to get those answers, right? So the first one is, you got your return almost done. Is it completely accurate? And do you understand why the numbers came out the way that they did? We're in the middle of the second question, and that is, all right, now that it's accurate, is there anything that I can do to improve my tax situation? So let's run through that list again, but then also there's a big impact with some of those, right? So some of the pre-tax things that you can do yet right now for last year, IRA, right? What's that? Run through that list again, Ryan.
Yeah, so the quick and easy ones are traditional IRA, Roth IRA, as well as health savings account. And the reason you say Roth IRA, that's not deductible. Why does that matter? It could matter to if you're allowed in the retirement savings contribution credit. So we call it the savers credit. If you're eligible for that, it's a huge. I mean, it's a nice credit as an incentive to contribute to the plans.
Yeah, so you want to know and understand, hey, if I put money into my retirement plan at work, should I fund a traditional deductible IRA, a traditional after-tax non-deductible IRA? What should I be funding? And this is where you really want your tax preparer to help you with some planning. And if you haven't done it in the calendar year of 17, these after-the-fact strategies are just crucial, because if you don't know about it, it's not an opportunity and you'll never get it done.
A lot of tax benefits are based off of a calculation of your adjusted gross income, and that stuff is confusing. It is so confusing, and you don't know how close you are to being phased out from this or getting that. And so that's some of the reactive things that you should do in answering this second question. Well, if I do a Roth IRA, that doesn't give me a tax deduction, so I shouldn't do it. No, it might give you a tax credit based on where your adjusted gross income is. Or should you do a pre-tax to lower that adjusted gross income because you were getting phased out of some benefits or so on? You've got to look at all of those ideas and then say these make sense or these don't make sense.
Yeah, and even whether I'm using a Roth IRA to try and capture a retirement savings credit, or what if I just have some money that's growing, whether they're lazy dollars sitting in the bank and they're really for the long term, or it's an investment that's growing taxable? What if I could take a taxable investment and shift it over to grow tax-free? Well, I only have a certain amount that I can push into that structure per year. I get a coupon per year.
Yeah.
And so if I didn't use my coupon for 17, I still have until April 15th to use that coupon. After April 15th, I can't do it.
You got it.
So this is where you want someone looking and saying, "Oh, look, you have these dividends, you have this interest income. Hey, have you considered getting these resources? If they're long-term resources, have you considered positioning them to grow tax-free?"
Really quick, if you're getting a big refund, that's another strategy that I like. If you're set up to get a big refund and you think, well, wait a second, should I take some dollars and fund one of these things to improve my tax situation and effectively create a bigger refund and play the shell game with dollars to improve your tax situation? That's just huge. And again, you just need to meet with someone, sit down with your certified financial planner, and make sure you're going through that list. Now, Kevin especially has been very anxious for the third question, and I know you are as well. So you've got an accurate tax return. You know why the numbers came out the way they did. Second, you've evaluated every possible option of improving last year's tax situation, and you've ruled in or ruled out each of those strategies. Now, and almost everyone skips this step, especially if you do it yourself, and I would argue it's the most important, especially this year, and that is look forward at this year. How is your tax picture going to change, and what should you be doing right now about it?
Yeah, if you have not scheduled a meeting with your certified financial planner to talk about the changes and how they're going to affect you, or if you don't have that meeting already scheduled, call your planner. If you don't have a certified financial planner, go online, find one, but get that meeting scheduled, because there are things that you should be doing. And if you do them early in the year, you've got all year to get these things implemented. If you wait until November, it's a lot harder to make these changes.
I'm going to just share a quick story, and then I'm going to let Ryan share some of the big changes that have occurred with the tax law. But some dear friends of mine that I've been blessed to serve over the past, probably decade. They've got 4 kids, and in today's world, that's a big family. And so in the previous world, that's a lot of deductions, a lot of tax credits, and so on. Well, the last 2 were twins, which has probably created some dynamics, 18 years ago or 20 years ago or so. So they were twins, and they both graduated from college the same year. So think about this. In the old world where you used to get deductions, each of them were a $4,000 exemption deduction. And then they were both in college, so they were each getting the American Opportunity Tax Credit, so another $2,500 each. So $5,000 of tax credits they were getting, Plus, it equated to about $2,000 of tax savings from deductions. $7,000 of tax savings. They got 1 year, they were gone the next when the twins graduated. If you're not thinking about that in March or February, you don't even have a chance to change withholdings to catch up for that. So there again, you've got to answer this last question. How's my tax situation going to change this year? And what should I be doing about it? Now, we know everyone's tax situation is changing this year, thanks to the friendly folks in Congress. Not so friendly. Ryan, let's talk about some of those big changes that people need to be aware of this year.
Yeah, so the thing that is going to impact everybody is the tax brackets change. So that's an easy one. Luckily, Congress is taking care of it where you don't have to change a whole lot on your actual paycheck withholdings. So they have just recently released the new tax withholding tables to the employers. So employers will begin using those tables in February when they're calculating paycheck withholdings.
I'm going to interrupt you.
Let's hear it.
I love you, but I'm going to make it a little more firm. Bring your most recent pay stub into your tax appointment. Because, yes, Congress has changed or the IRS has changed these withholding tables, so it's going to happen automatically, but you don't know if it's right. You don't know if it's right. They're just automatically doing some calculations for the general people.
Yep.
Your situation specific to you. So bring in your pay stub that will show this updated withholding, and we can take a look and say, yep, that looks good, or no, we've got to make some changes.
Yep, good point. So yeah, the withholdings are going to change on your paychecks in February, and as Mike said, double check, make sure that they're right. It's not going to change if you got a huge refund that you need to change, you still need to change that for 18 because you're still going to get a huge refund if you don't change anything.
Right.
So yeah, that's an easy one. A couple of the other things that are really, really different this year, for a lot of the standard deduction is doubling for 2018 from 17 to 18. So for a married couple, the standard deduction is going up to $24,000. That's huge. I think in the past, or currently, there's about 30% of Americans itemize their deductions. That's going to drop down to, they're predicting about 5% of households are going to actually itemize deductions.
Yeah.
That's amazing to me, because I would have guessed that it was a lot higher than 30% to begin with.
I would have guessed that too. In fact, we've talked about it on the show before. I actually think it could have been 35 or 40, but people just said, no, I'm not keeping those receipts. And I think now that they've doubled the standard deduction, that's going to be even more tempting. I'm going to make this donation, but I'm not going to keep track of my receipt. Or I'm not even going to worry about keeping track of those things. No, you still need to. As I've talked to a lot of people about this rule, and they say, well, now I get this double deduction. No, your itemized deductions were $32,000 the previous year. You still need to track all that stuff. All of this stuff still matters to you.
Yep.
So tax brackets are changing. That's impacting everyone. Standard deduction is changing. I'm assuming we're going to touch on in just a second the special deduction that you get for every head in your household. And that's a big change as well. Credits are changing. We've got a lot more to hit, as well as some really, really critical tax questions that we've received from you. That and more coming up here on Wise Money with Korhorn Financial Group. All right.
Sorry, that time went away fast.
Sorry about that.
It just flies.
Mike distracted me when he was talking about his dear friends.
D-E-E. D-E.
I was thinking, all my dear friends are in the freezer. Okay.
I don't have any dear friends, Kevin.
Casey, you should.
Oh, I agree.
Okay.
Are you stepping out?
I'm going to step on out. I'll let you guys rock it out.
Got it.
That was just segment 2, right?
That was segment 2.
Man.
Was it really?
Goes fast.
I know.
Or slow, depending.
So I'll pop up and pop in?
Yeah.
Yeah. Okay. And I need to be in Elkhart at 1. So I'm assuming,
Who should sit in on my 2?
I don't know.
Okay, we'll figure it out.
Yeah. All right.
Hey, Andy
Good
Birdsall's
stuff.
going to be in the house today.
Really?
Yeah. Are you going to be around this afternoon?
Should be. Depends. I've got Jenna with me, so
Yeah.
I told her I had to come in and do this and do
Get
some
her to
more.
work, dude. She can...
She is.
I need to change out the transmission in my truck. Got to take my weight set from the basement up to the attic. There are a number of things you can do.
Garage door opener.
Yeah. Return on that investment.
All right.
A ridiculous thing I ever heard in my life. Keith.
Be up soon.
Sure. Let me know about Israel.
It's still there.
All right. I'm assuming you've got a couple other things on the list. I mean, we could even spend this whole.
I don't know. I don't have a lot of really good ones.
I mean, we
But yeah, we can talk about the exemptions and credits.
talk about the exemptions, talk about child tax credits, and then I'll probably just throw some other. I'll try and stump you, and then we'll get into questions. And you're ready. The HSA. Ooh, home equity line interest. Come on, that's a big change, but we'll hit that in the question. So segment 3. With the new tax law changes, should you change your mortgage? That's an interesting question. We've got that one coming up and several others here coming up on the program today. This is Wise Money with Korhorn Financial Group. My name is Mike Bernard. Next to me in the KFG studios, Ryan Fair. Kevin Korhorn was with us earlier as well. We're talking about taxes. We're talking about the 3 most important questions you need to answer every single time you get your taxes done. And sadly, most people are 0 for 3 if you do a quick audit, quick inventory. Special thanks to Bethel College Adult and Graduate Studies, as well as Diane Bennett with RE/MAX 100 for making the Wise Money Show possible. Thank you very much. If you have any questions, as I know taxes always spark a lot of questions, we've got several to hit yet today. Reach out to us in a few different ways. Call or text 574-222-2000, wisemoneyradio.com, online and social media, Facebook, Twitter, and YouTube at Wise Money Radio. All right, so the first question, when you get your taxes done every single year, is this an accurate return? Did I get all my deductions and credits? And do I understand where these numbers come from? The second, once you have that, okay, it all looks good. Now you have to ask yourself, is there something I can do to make it look better? Make that list. Make the full list and then go through, hopefully with your certified financial planner, and say, this one makes sense, this one doesn't, this one doesn't, this one doesn't, this one does. Be aware of phase outs and how even the slightest change can open things up or get rid of certain things. And then lastly, the most important one, third question is, all right, now that previous year's tax return is done and it looks as good as it can possibly look, how's my situation going to change this year? And what should I be doing about it right now? Everyone's tax situation is changing this year. So, Ryan, we've touched on a couple of changes. Let's keep going of the big changes in the new tax law that are going to impact everyone.
Okay, so yeah, we talked about the tax brackets. I think the next biggest one that's going to affect everybody is the exemptions that's related to the standard deduction, and then also the child tax credit. So exemptions, you could get scared because you hear exemptions are going away from 2018 forward. There are no more exemptions for claiming independent. So in the past, that was $4,000 deduction, $4,050 that you reduced your taxable income by.
Per person.
So you also then receive child tax credit, which was $1,000 per kid under age 17. And then that is a big change that they've doubled it up to $2,000 per child under 17, which is huge. So
for most people, you and I'm glad you're explaining those together, and we got cut off there with some commercials in between, but you really need to talk about the standard deduction, the exemption deduction, and the child tax credits. You really need to talk about all of them together.
Right.
Because in essence, what Congress did with these tax changes is they combined your exemption deduction with your standard deduction. If you've got a lot of kids, you lost a lot of deductions. Hopefully those kids are under 17 and you've made up for it with child tax credits. But there's a pocket there where you have a lot of kids and they're age 17 and they're not going to school or they're not yet in school, where you need to be very careful and really need to sit down proactively right now in February or in March and map out how is this going to impact you. Yeah,
and I think it's going to be, as you mentioned, the 17 and 18-year-old dependents where it's going to throw things off a little bit. Congress added, as part of this new tax plan, they've added a new family credit, family member credit. So we talked child tax credit. That's the $2,000 one. For those that don't qualify for that, usually based on age, there's this new family credit. It's $500 per person or per dependent in your household. So if you got a 17-year-old child, they're still a kid, they're still a dependent, they don't qualify for the child tax credit, but they do.
They might. Say might.
Okay,
Can't say
might.
do.
I know,
Yeah. But they might.
They might qualify for the other family member tax credit, which is a $500 credit. So that could also count for mom and dad. If
Yeah.
mom and dad are dependents of yours, they could qualify for this additional family member credit, where prior to that, you could claim them as a dependent. You don't get a dependency exemption deduction any longer, but now they still could qualify for the $500 family member credit.
So don't take that and just go off to the races and say, okay, that I qualify for that because of my situation. There's
Right.
several questions you need to answer, and you need to answer all of them the right way in order to be eligible for that. So yes, after all those deductions and credits, the tax rates are lower, but whether you landed on the good side or the bad side of those deductions and credits is really going to have a big impact on your tax return. They've already changed payroll withholdings, but they might just reduce yours down because tax rates are going down, but you might end up on the wrong side of the street with those deductions and credits and now have less withheld and pay a little bit more tax. And so you just need to watch out for that.
Yep.
Are they changing anything with the college tax credits?
They are. So before, in 2017 and before, we've had two different tax credits, the lifetime learning credit and the American Opportunity Tax Credit. They've basically merged both of those into just the American Opportunity Tax Credit. They've changed a little bit of it, but they've added on an extra year and basically just did away with the lifetime learning credit. They also did away with the tuition and fees deduction. That was another place that most people didn't use that because the credits were better in almost every situation, but there were a handful of people.
There were a couple.
Yeah, there were a handful of people where the tuition and fees deduction was better, so we would account for their college costs there. So that's gone for 2018 forward.
Yeah, that was a lot of where doing it yourself or doing it online would get that mixed up. If you were in that rare camp where the tuition and fees deduction was better, if you weren't sitting down and working with someone on that, you may have gotten the wrong one there. That's moving forward. Speaking of the college stuff, you do want to make sure you're making a great decision on what college benefit to take for 2017. That's part of answering that second question. What can you do, and making sure that you've got everything set up the way it's supposed to. But looking forward, yeah, that's changing a little bit.
Yep. And also, real quick, education related, they changed some of the 529 plan rules.
Yeah.
Where they actually are allowing you to use that for private school that are basically K through 12. Where before it was always higher education was the only thing that 529 funds could be used for. And so that's a good benefit that they've kind of widened the door on the 529 funds.
Okay, a couple other changes you need to be aware of. And again, we're hitting these popcorn. We've done it before. If you're a student of the game and you really like reading about this stuff and listening about taxes, you've probably heard all of these before. The point we're trying to make is not give you more information. The point we're trying to make is how does it apply and impact you? And you need to determine that right now and make sure that you're set up appropriately. So businesses, small businesses, many, I want to say most, some, we don't know exactly, but could have a new deduction this year that would make a difference on how much what your estimated tax payment should be for 2018. And a lot of businesses who have good profits and so on, it's kind of tough because you file your taxes right now and you have to pay whatever is due, and then you have to pay your first quarter estimate, so it's kind of a double whammy. Well, you need to take into account if you're going to get a tax deduction or not.
Yeah, for sure. So I was hoping you weren't going to ask me about it, Mike. This is the most
confusing.
Complicated part of the whole new tax bill, at least from what I've read. They added this new, so the corporate C Corp tax rates, they lowered significantly. That was the major part of the tax bill. It went from 35 down to 21%. But those are for typically large companies. The small businesses that are usually pass-through entities is kind of our jargon. Usually those are known as S corps or partnership returns or even sole proprietorships. Those businesses, Congress made an adjustment to reduce the tax on those also to kind of compensate for what the big boys get with the C corps, and it's a 20% reduction in taxable income. So on the face, that's awesome. I mean, it's a 20% reduction, which sounds good, but actually figuring the 20% is impossible at this point, at least. The IRS hasn't issued any actual guidance to clarify, and there's all kinds of if this, then that, and reduce it by this and add this, and it's not as clear cut as it sounds.
Yeah. We've got to touch on a couple more changes there, but also, should you be making changes to your mortgage because of these new tax laws? We've got a great question from Roger. We've got that and more coming up here on Wise Money with Korhorn Financial Group. Okay. Yeah. You did that perfectly. I wasn't intending to ask, all right, give me the details. I actually wanted you to say, it might exist, it's complicated, and we're waiting to find out exactly how this is going to be applied. On YouTube, you've maybe have heard before that, so Congress creates these laws, but then the IRS needs to interpret them and say, well, this fits, this doesn't, sort of thing. The 401k is a great example of this. Congress created this loophole or this thing, and it wasn't until a couple years later where someone actually said, wait. The way I read this, you can make a contribution and have it go pre-tax. And that's not what Congress necessarily intended when they put the rule out there. But IRS looked and read it and said, yes, you can. Yes, you can do that. And now we've got this huge monster, the 401k. Congress didn't dream up, we should create individual savings accounts. That's what we should do. Nope. IRS need to interpret it. So
it's funny, I actually had a meeting yesterday at the IRS in downtown South Bend, and the agent that I was talking to was basically complaining about how Congress and IRS how they're conflicted.
Oh, is that right?
Yeah.
We should talk about that on the air real quick.
But
Especially,
no, let's not.
Every time you talk about agent, I think of the Matrix. Like, I think the IRS is... What was the guy's name from the Matrix? So Neo was Mr. Anderson, but the Mr. Smith. I just view the IRS. I'm just assuming you walked in all casual with your, gas and oil signs, and you've got a bunch of dudes in black suits with these glasses on. Mr.
Not even
Smith.
close. Yeah. Not even close. But
all right.
It'd be cooler if it was.
Cool?
No.
Fourth segment, if we we've got to hit these couple changes. The only other one I wanted to hit was the mortgage interest and so on, and we can have that segue into the questions too. So.
Yeah, that's one too. I don't know how, which is basically what I started saying. I don't know how
they're going to apply.
We're going to know, or how
right.
the bank. I don't know if the lenders are going to basically not issue 1098s if it's a home equity line versus.
Yeah.
I don't know from the lender side. They know that it's. I mean, yeah, I guess they obviously know if it's your primary mortgage or your.
Do you have contribution limits for HSA?
I do.
Okay, cool. Because I know we already touched on that earlier, but I think we.
I think that was the last show. Oh, we touched on you can make contribution.
Right. We did talk about it on the previous show as well, though. But all right, so fourth segment, land on the plane. Thanks so much for joining us. This is Wise Money with Korhorn Financial Group. My name's Mike Bernard. Next to me in the KFG studios is CFP and CPA Ryan Fair. Kevin Korhorn was with us for a bit as well. If you've missed anything, oh my goodness, we're talking about the 3 most important questions that you need to answer every time you get your taxes done. And then as part of that, we've just been recapping what in the world is going on with these tax law changes and how's that going to impact you. So if you missed anything, catch previous episodes, wisemoneyradio.com. You can catch previous episodes right there, as well as submit a question right there on the right. Every episode's on the YouTube channel at Wise Money Radio. Find us there. It's also on podcast, iTunes, Google Play. Get us there as well. Lastly, if you have a question, you can also call or text 574-222-2000. So this last question that you need to answer every time you get your taxes done is, how's my tax situation going to be different this year, and what should I do about it? We've talked about the most important, the biggest ones that are changed with the new tax law, But inside of itemized deductions, and fewer people are going to itemize, but inside there were a couple tweaks. We don't need to get way down in the detail, but a mortgage interest, if your mortgage is too high, if your state tax is too high, blah, blah, blah. Can you just touch on those really quick, or just what would you point out that so that people can prepare for those changes?
So yeah, the state tax one is probably going to impact the most people in our area, or even nationwide. Basically, they've capped the amount of your deduction for taxes paid between state and local income taxes and your real estate taxes. Before, you could deduct as an itemized deduction 100% of those, no matter how high they were. 2018 forward, they've capped those at $10,000. So if you're making, so we'll just leave it at that. They're capped at $10,000.
They're not capping property taxes.
That's included as part of.
Oh, wow.
They're added together.
Wow, that's crazy.
Yeah.
Yep.
So, they're not capping the amount of tax that they're charging, of course. But yeah, the deduction they've capped. So that's one part. And then the mortgage interest, 2018 forward, you're no longer going to be allowed to deduct your home equity line interest as an itemized deduction.
Yeah.
So the other mortgage interest related one is related to acquisition debt. Doesn't affect a lot of people in our area, but basically you're only allowed to deduct mortgage interest on the first $750,000 of mortgage debt. And prior to 2018, it was $1 million you could deduct up to. So again, in our area, most houses aren't $1 million.
Yeah, and by the way, if you've got a house that's worth $1 million, don't get a mortgage on it. Hopefully you're in a position where you're paying cash or you've got a lot of equity in it. So yeah, okay, that's a good segue because we've got a couple questions that really line up right into that I just want to hit for your benefit. So very first question comes from listener Evan. He says, my company does a $1,500 contribution to my health savings account every single year, and because I'm fairly healthy, I really haven't needed to contribute anymore. Is that the right approach? It depends, Evan. Ryan, share the contribution limits.
Yeah, for 2017, since you can still make those, for single coverage, it's $3,400. Family coverage is $6,750. If you are eligible for catch-up based on your age, you can do an extra $1,000 catch-up. So those increased just a little bit for 2018. So instead of $3,400, it goes up $50 to $3,450 for a single plan, and goes from $6,750 up to $6,900 for a family plan.
A lot of people get confused because when you're looking at matches to your 401k or 403b, the contribution limit does not include the employer match. But on the HSA, whatever the company contributes does count towards that limit. So, Evan, if your company is doing $1,500 into your HSA, number one, that's a huge benefit. Oh, that is huge. That's an extra $1,500 raise that's not taxable to you. That is awesome. You can take that money wherever you go. But should you put more in is really a tax question as opposed to a health question. Of course, if you know it's going to be a uniquely unhealthy year, a friend of mine last year, actually a mutual friend of ours, 3 surgeries last year and 1 for his son. I know, it's just crazy. It's just crazy. And he has a high deductible health plan. So if you know that's on the docket for 2018 somehow, you're going to want to make sure you've got enough set aside to cover your deductible. But if you're healthy, it's not really a question of how much do I think I'm going to spend. It's, do I need the tax benefit? So, Evan, if the company's put in $1,500, you got to do some tax planning. Look at your tax situation and say, all right, should I put in an extra $1,900? What would that do on my taxes? For a lot of people, and I'll just round here, if you put in an extra $2,000, for a lot of people, you'll probably get an extra $500-600 back on your taxes. Therefore, it's really costing you only $1,500 to put $2,000 in your pocket. That's a good deal, depending on your overall financial situation, your financial goals. Something you might want to consider. Yeah, and Kevin was talking about it earlier, but a shell game of if you've got the money sitting aside anyways in a taxable account, this is another tax shelter to get it sheltered from taxes and gross tax deferred, tax free. And let me just touch on one other thing and why I so passionately believe you've got to answer those 3 questions we already talked about every time you file your taxes. Because right now you might be looking and saying, yeah, you know what, that makes sense, Mike. I don't agree with most things you say, but I agree with that one. And I'm gonna put a couple extra $1,000 into my HSA for last year. Well, if it makes sense last year, does it make sense for this year? And if it does, should you have that money contributed out of your paycheck instead of out of your checking account? If so, there would be some additional tax savings for you. Money that goes into your HSA just out of your checking account saves you fed and state taxes. But if you contribute out of your paycheck, it saves you fed and state, but also payroll taxes, FICA. It's a big deal. So you want to get ahead of that as well. So great question, Evan. Oh, last thing. A lot of people are looking at their HSAs as an additional retirement savings account too. If that's appropriate for you, Evan, you might want to consider funding more. Okay, so we just hit on this issue. Fan of the show, Roger, sent in this question. I've heard that you're not allowed to deduct home equity line interest on your taxes. Is that true? Ryan already said that it is. We'll let him elaborate. But is that true? And does that mean I should refinance my mortgage to pay off my home equity line? Should I also consider saving less for retirement and paying more aggressively on my mortgage now that I won't itemize and the interest won't help me on my taxes? Roger, oh my goodness, we could do an entire show on that. And I don't know if we're going to have the time to do that question justice because there's a home equity line issue. Then there's the issue of should I refinance? Then there's the issue of regardless, even if you just have a mortgage, if now doubling the itemized deductions, you're not going to deduct your mortgage interest, should you reprioritize your goals and pay more aggressively on your mortgage? Ryan, share your first thoughts.
Yeah, so I kind of cheated earlier and said the home equity loan interest is not going to be deductible in the future. I'm assuming the lenders, this is another area where there's not much info yet about how that's going to be tracked and what the lenders are going to do if they just don't issue a 1098 for home equity lines. That's good. But yeah, as far as the mortgage interest, you're right. A lot of people use that excuse. Oh, I've got a mortgage so I can have a tax deduction.
Yeah.
And that is going to go away for a lot of people in the 2018 forward. So.
I've always disagreed with that argument. A deduction it always helps you a percentage on every dollar that you spend. So if you spend $100 in interest, well, yes, you get a deduction. So it might help you $25 on your taxes, but it still costs you then $75. So I disagree.
I think it's Dave Ramsey too that makes the argument that says, hey, if you want $100 or $1,000 mortgage interest deduction, give $1,000 to charity, and it's the same deduction, same benefit.
Love it. So here's the idea: should you refinance your mortgage? What do you think?
It sounds like it. If you've I mean, again, there's not any guidance out from the IRS on this yet, but it sounds like that's what you're going to need to do to consolidate the debt. Now, the only thing is that the mortgage interest still has to be considered acquisition indebtedness.
Yeah.
For
But how will they know? Yeah, right. So
Mike, that's not the right question.
There are a couple traps you need to be aware of here.
Right.
Number one, when you do that sort of refinance where you're paying off other debt and including that in your mortgage, that's called a cash out refi. And usually your interest rate will be a little higher and you might even have higher closing costs. Quick sidebar, a lot of banks are coming out with no closing cost loans. So you need to be aware of that. So, it's something to consider. But once again, talk to your certified financial planner to see if that makes sense for you. Roger, I'm assuming we're going to pick this question back up in the future, but that is all the time we have for today, folks. On behalf of Kevin Korhorn, special guest Ryan Fair, and myself, Mike Bernard, and all of us at Korhorn Financial Group, have a great weekend. We'll see you next week for Wise Money with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.